good afternoon, and welcome to the fourth episode of Yolo Uncovered. Here today with Andrew Clover, the CEO of One.io. How are you doing today, Andrew?
Doing very well, Pierre. Thank you for having me. It's really great to be here.
Absolutely, and it's been great to get to know you during the great kind of YOLO gatherings here over the last couple of years. Always a favorite of mine in the calendar. And obviously, through the conversations we've had in the past, I've gotten to know you a little bit and the company that you run. It was previously called Ames, and it's now being rebranded to One.io, a bank essentially specializing on crypto and the iGaming industries. But I'm not gonna steal this like half as the introduction here, but I'm going to leave it over to you, Andrew. Can you talk a little bit more about One.io, what the company is about, and what problems are you solving?
Sure. So one essentially is solving a lot of the problems that you face every single day. So I suppose if you step back, the original idea came to me out of one from living and breathing the crypto industry from early on, and sort of having this wonderful new expansive industry erupting, technologies all over the place, frontiers being pushed out. But it always came back to a very simple fundamental problem. So if you don't have a bank account and you can't turn your crypto into real hard fiat money at some point, you kind of don't exist as a business. So we're solving this international money movement and providing accounts for this sector because traditional banks, as we all know, do not want to serve this. So means that the usual, if you're operating in a usual industry, what you take as your God-given right, just take for granted, being able to turn up, open up an account, receive money from your clients, and pay your suppliers. That very basic functionality doesn't exist, or it's really hard to come by in these industries. So we're taking away all of the problems, the headaches, and allowing us to deal with this section, and allowing the companies operating in these sectors to get back to what they're doing best, which is furthering the industry that they're operating in.
All right, great, Andrew. So you mentioned that you were an kind of early adopter of crypto, and I just want to point out here that yesterday was the International Bitcoin Pizza Day. When the first person transferred 10,000 bitcoins to buy a pizza. And you know what? Just to go a little bit sidetrack here, everyone talks about the person who bought the pizza for 10,000 bitcoin, but no one ever talks about the person who sold the pizza. And there was an interesting article the other day of someone that actually found this person who actually sold this pizza for 10,000 bitcoins to ask them if are you rich today, basically. But it turned out that he just kind of routed those 10,000 bitcoins on to something else, something similar. So yeah, that's the story about that. So, as a little sidetrack here today in today's YOLO Uncovered, you learn something new every day.
Indeed.
So
I do know the other guy. You know the story about the individual who lost lots of his bitcoins on the hard drive in a rubbish dump somewhere in the UK. That's probably a more painful story than at least the pizza guy got a pizza for it. This guy didn't get anything at all.
at least you got a pizza for
Yeah.
it. Fantastic. So Andrew, so essentially to summarize the business in layman's term, you are essentially a bank that is taking on accounts from kind of these like more riskier industries, or at least that's what the traditional banking system would label them as, like the iGaming industry and kind of cryptocurrency companies. How do you manage that risk that the traditional banks are not willing to take? Like, how do you make sure that these accounts are safe?
Sure. So first of all, we're not yet a bank. We'll be able to call ourselves a bank, and we've got some licensing applications going through at the moment. So once those come through, we will be able to. But we are a banking platform giving access to payment rails, just like a bank would be able to. Just to clarify, otherwise the compliance department will shoot me if I don't mention it.
Yeah, fair enough.
So I suppose the first thing that we're able to do is because when you look at traditional bank organization, they have set up their policies and procedures to cover any type of industry. So they are complete generalists. So they have to deal with everything from baking cakes to internet service providers and to mining operations to everything in between. And they have to set up a whole series of policies and procedures that captures any eventuality. Now, of course, it's not actually possible to make a single set of policies and procedures that covers every single eventuality. So they'll say, okay, we'll take the 80%, the easy 80%, and let's just deal with those. All of these you'd say higher risk, I'd say probably more innovative sectors on the slightly on the edges those fall into very specialist categories. So we're able to serve those because we take time to specifically understand the industries and set specific policies and procedures around managing those sectors specifically. And by being able to specialize on certain areas means that fine, they're considered by some metrics higher risk, but because you understand the risk, you're able to take that on, understand it, mitigate it, and understand at the end of the day, it's probably just a lack in knowledge and understanding. Being able to understand the crypto industry, arguably, I actually argue it's a lot lower risk dealing with crypto companies than dealing with traditional fiat companies. Because, as you know, you can trace every coin back to the beginning of time. Yes, there are arguments about how ways that you can circumvent the system, but then there's ways you can circumvent the traditional system as well, and those are sort of tried and tested. But because the traditional system's been so heavily ingrained and rooted, the traditional banks are comfortable with the traditional system, they're comfortable with traditional risk. Something's new, and I suppose the other side of it is that the banks, traditional banks, have this big reputation of regulatory overbearing Section 2 to protect. So they're not incentivized to break into new industries, to support new industries, because they've got their other. So this new section industry might account for now 1% of their accounts, but they've now got 79% of the 80% we spoke about before to also think about. So by specializing on these particular areas, building up expert knowledge and special policies and procedures around it, we're able to manage the risk and serve the industries very comfortably.
Right. And recently, this year has been a lot of turbulence within the banking sector globally, of course, with First Republic Bank, Signature Bank, Silicon Valley Bank all folding, and the feeling is very much that customers are scared of where do they put their money? Are their money actually safe? So on and so forth. Has the turbulence in the banking world affected your business as well? Like, what has the outcome for one been through all of this?
So in short, we've come through completely unscathed, which is a testament to our approach to risk management and how we address our accounts. So we have multiple redundancies across multiple regions across the world, across multiple payment rails, and that's today, and we're just growing and expanding that as we go forward into the future. And the other thing to say is that the turmoil in the banking industry was entirely driven out of greed. So in all of the, and I'm sure we can all find the senator grilling the CEO of the Silicon Valley Bank. That was quite an interesting grilling. But basically said if they had just done what's very, very basic risk management on their side, which is hedge interest rate risk, which would have hit profitability, there would be nowhere near this problem and risk, and that translates through quite a lot of the banking sector. It's incentivized and the structures all set up for short-term profits and gains. So you look at the directorship turnover cycle, executive turnover cycle, and bonuses. There's a lot of claim that they are long-term, but what's long-term in terms of a banking cycle? It's not 1 or 2 years. You're talking 5, 10, 25 years onwards. And that's the sort of terms in which we're thinking of. So you don't run out and try and make all the money tomorrow. How we're really aligned at one is we offer the base set of products. So the accounts we almost offer at break even. We call them our baked bean loss leader. And if we can provide additional products and services that are of benefit to our customers, then that's when we also start benefiting as well. All of those products and services are offered in the most lowest cost fashion that's possible. Because at the end of the day, it's about two things. Yes, profitability, but if you don't exist, as we've seen, even it doesn't matter how big you are, then you're not going to be around to benefit from it going forward.
Right. So essentially, Silicon Valley Bank and others were mismanaging the client's money by investing it in assets they thought were not risky, but they turned out to be very risky. And you're saying that in you guys' case, when a client deposits to one, you are not exactly like trying to multiply that money too many times. So let's say you are being much more responsible, let's say, with the client's deposits than these other banks.
Yeah, I think mismanaged would be potentially harsh, and there might be some particularly egregious consequences for that for individuals. But definitely, the risk to reward trade-off was not there. So the risk to the customers was absolute. The rewards to the individuals at the banks was also pretty high, but the money that they were going to gain versus what was at risk for the customers didn't match and didn't line up at all. And that's where the disconnect came. And over, obviously, we're talking about different scales of organization here, where one is, or hopefully we'll get to something as big as that. But all of that originally gets rooted right back to culture, which you ingrain right at the very beginning of an organization. It becomes extremely hard to change later. So we spend a lot of time putting customer, actually we put everything customer front and center with what we do, and us as our team and employees about how we actually engage with one another and go forwards.
Right. Before we kind of jump into to one end organization again, just a final question on that note. Do you see the banking sector stabilizing as we go through the year now, or do you think there is risk for further of these like major big bank failures? What's your thoughts on that side?
Um, so we're not out of the woods, for sure. There's still, say, risk within the system, and there will be risk within the system until we get to the point where interest rates are at least plateauing and starting to drop down again. And the longer they stay at a high rate, there's more risk. But what has been shown is that the banking sector is very quick to react. So Credit Suisse, which they learned from the previous crises, Credit Suisse could have been an absolutely huge, could have been the next Lehman Brothers, if not worse. But both the Swiss government realized the severity of it, the banking industry as
Yes.
well. And then there was First Republic in the States, which they had other peers also respond very quickly around it. So I think a lot of lessons have been learned. Um, do I think there's a risk that another bank could fail? Yes, there absolutely is in the system right now. Do we think it will ripple through and have a major impact on end depositors? Because fortunately, or with all the crises that have happened, actually how it was all managed, the end depositors have not lost out in any of the. Correct me if I'm wrong, but I don't think in any of the turmoil. And there's been a lot of institutions that have lost a lot of capital in between, and potentially, well, we need to see how the full unwinding happens with Silicon Valley and the rest with the Federal Reserve and their process. But overall, it's been quite well managed.
Right. The money printing machine is hot at the moment to cover all of these potential lost deposits. So zooming in on one again, Andrew, I want to talk to you just about kind of your journey as a startup founder. Obviously, getting to the point where you are today, you built an incredible company, and there's still a lot more growth to come here. But how has the journey been to date, building 1.io? Have you had any major stumbling blocks perhaps on the way to get to where you are today?
Um, so I suppose first of all, yeah, one started from extremely humble beginnings with a laptop and a bright idea, and it's grown into what's an amazing company to date. And I'd be lying to say everything's been completely plain sailing. As with every company, I'd love to say that we just went from here to zero and it's all been amazing. But no, there's been has been a good roller coaster, but the trajectory has firmly been upwards. And it's interesting because it's not for the faint-hearted starting a company. And you go through a series of phases, and each phase, you need to reinvent yourself, and address the new challenges that go with that phase. So the first phase is survivability. You've come up with an idea, you just need to get and exist, and quite a lot of it comes into a bit of capital. And next phase you go into is viability. So fine, I'm existing and alive, but can I turn this into a real business venture, or is it still just a wonderful idea? So one's passed through both of those, and we're now what's in the scaling phase. So you turn yourself from being an organization of particular size, can this expand at a reasonable pace? And I think the scaling phase is probably one of the biggest challenges that you're in right now, because there's all sorts of pools that you could go in 12,000 different directions if you don't take the right step. But it does come with its other benefits. You reached a size of a certain critical mass that, okay, you're not, if you take in the very early survivability stage, if you make one big mistake, that could be the end of the business. Now at least, okay, if you try not to make mistakes, but mistakes will happen. They're not going to be fatal. You have the resources to be able to course correct and move on from that. But overall, it's something that I would sort of advise everybody to at least try at least once in their life. Like starting a company, it's really exciting, something special from the beginning, that where you have your hands on something where you have to pull every single lever. Is like the company only moves if you get out of bed. To okay, you pull a couple of levers and other people are starting doing things, and eventually we're now at sort of the stage where you don't have your hands directly on anything day to day, and you're helping to guide and influence people and direction of the business, which comes with probably its probably final challenge, and it's something that gets forgotten about quite a lot, is remembering that business is all about people. And people are very interested setting strategy, setting finance, being marketing strategies. There's all very big, probably almost formulaic textbooks with how you can go and do that. How you address the people side, that's the slightly messy bit that but if you get it right and it comes back to setting your culture correctly, it's super powerful. It makes it a really enjoyable place to work, and your business puts you on a fantastic footing for the business to go forwards.
Yeah, you talk about something interesting here, kind of these transitions when you build a business, and also as a leader, Andrew. I mean, you're the founder and the CEO of the company, and as you build the company and you start building the amount of employees that you have in the company, you also need to kind of go through this transition as a leader as well, right? So you point out here, for example, in the beginning, you're very hands-on and you take all the decisions, but then at some point you need to hand over the decision-making power to other people. And I think that is generally something that some leaders, they kind of fail at or they struggle with. They turn into this kind of like micromanagement style, and they have a really hard time to let go, which then means that it's very difficult to scale, because at the end of the day, at some point you become the bottleneck, right? Like, have you gone through this type of transition as a leader? And did you feel this like kind of nervousness of handing over decision-making power to others?
Absolutely. And then also the other side of it is that no one gives you a manual with how to do it. All of a sudden, you're thrust into this position where you go from being very, very early on, when it's your hands-on, you're managing things, so to all of a sudden you're in this leadership position. But I've been very fortunate. I've had a lot of, and it's again what I advise anybody going through startups is find a couple of very core trusted advisors or mentors that can help you guide you through this process. And I've been very lucky. I've had a couple around them. Tim, actually, of Yolo, has been one that I've leaned on quite a lot, and that makes a big difference. Even if it's just lending an ear to, because people say it can be quite lonely at the top, and you could get quite stuck in your own head with just almost debating with yourself, and it doesn't really helpful. Just externalizing and vocalizing specific points can be extremely useful. But again, it's a challenging transition to go through, but then they say as you do go through all the different phases, it becomes extremely rewarding. I remember very early on having access to every single bank account, seeing every single transaction going through the system, and thinking if I give this to somebody else, they're just going to send the money to a completely wrong place. And then that's where you get your faith back in people, and as you grow quicker, I've learned to give more faith into people and trust in them sooner as well, because that didn't happen. Everyone actually operated really, really well.
Yeah.
Yes, and I suppose the other side of it, what you've got to accept as well by handing off responsibility, is that mistakes will happen, and that's totally okay.
Exactly.
And what really matters is actually the response to the mistakes when they happen, and how the organization and people specifically deal with it. So by giving everyone the trust and saying when a mistake does happen, that's totally fine. They actually bring up the mistakes more often to you rather than trying to hide them, burying them, which is when you get into a problem, which probably links back to what we were discussing earlier, was how a lot of these issues in the banking sector have come about.
Yeah. It's great points for sure. And you mentioned, having people around you who you can lean on and ask for advice and so on. And obviously, and if I correct me if I'm wrong, but in 2020 is when you closed the investment and you brought Yolo into your cap table. It'd be interesting to kind of know little bit more of the fundraising process in itself. Like now you raised a couple of rounds, if I understand it correctly. And what have you learned through these processes of raising capital? What are some of do's and don'ts, perhaps, that entrepreneurs should think about when they consider to raise capital into the company?
Yep, absolutely, and that's right. We've just recently closed another round of financing, and these two, the one from Yolo and the one just recently, have been by far the most straightforward and pleasant fundraisings that I've been involved from. Partly because I suppose the first piece of advice is the best time, oddly, to raise capital is when you don't actually need it. When you have obviously a plan to go and spend what you're going to do money on, or growth capital, but if you don't need the funds, then you find a good synergy with the investors that you're talking about. Investors can see when startups or companies are desperate for capital, and that becomes very hard negotiations straight away. Also, they don't want to. No investor wants to put their money into a sinking ship. That's a very hard conversation to have. They want a ship that's floating, to use that analogy. The other piece of advice is to make it a no-brainer for the investor coming in. So really going in with a win-win mindset. I've spoken to quite a lot of startups who go out, and I've seen lots of pitch decks that come across the desk where you get to the valuation piece and they're offering up 5% or 3-4% to the investors, and they sort of say it's a little bit disrespectful because the investors speaking to are not stupid. They see this all the time, and you could start with that burnt scorched earth strategy of start really hard over here and then move all the way back. But in my experience, that doesn't bode very well. If you have a really thought out value proposition for the investors, give them a good amount of equity that they're going to be incentivized, and they can see a path to turn their money to many multiples. Because remember, when an investor is turning their money many multiple times over, and they're bringing all of their contacts, networks to support that, they're also doing the same for you at the same time. So by giving them a win, they're going to be giving you a very big win back, and I think it's something that gets forgotten quite a lot. Other good thing is prepare properly for the fundraising round. Have your pitch deck, spend a lot of time on your pitch deck, narrow it down, keep it very clean, crisp, and simple. So have a teaser document and have a longer pitch deck that goes into detail depending on the type of investor that you're going for. Have a data room that's ready to go. So as soon as you get a bite from the lead, you can send the link out the same day. That you're not waiting sort of a week to try and scrabble it together. Have the financials up to date. Have your lawyer ready to go. Just the normal preparation phases that you go to. Also, do the research. So for these two for the fundraising round with Yolo and the fundraising round which is closed now, we approached 3 investors. We knew exactly the sort of type of investor we wanted to. We researched it, why particularly our company would be interesting for them, the value add on both sides, going backwards and forwards, and then I made a direct approach. Yes, you can take the shotgun approach and go completely out to the market, but in my experience, really understanding and knowing who you want to get on board, and then you also tailor all of your offering to those specific people, understanding their background as well before you've even had that first initial meeting.
Right. So it's kind of like in your case, you went from this very laser focused sniper approach where you just had all the information sorted, nice, you knew everything about the investors, rather than this shotgun approach, just kind of spray and pray, send the kind of half-baked pitch deck out to 100 investors and just hope that someone will pick it up.
Yeah, I suppose one is quite lucky because both the time we've converted clients into being investors. So the knowledge of getting to understand who they are, it's a great sign. It's a great validation of trust and value in what we're building. And I realize not every company will have the ability to do that and to engage with the investor before trying to convert them into an investor. But at least doing all the background knowledge. So if you're approaching a VC fund, don't send it to 500, send it to the 5 that are in your sector and specifically targeting that have the allocation of capabilities and so on and so forth.
Yeah. So obviously in 2020 you brought Yolo on board on the cap table. How has the experience been to work with Yolo and be supported by Yolo as an investor? And a follow-up question to this as well: how important is it to have the right investor on the cap table in general? Like, do you prefer to have a silent investor who's just on the side, or do you want to have an investor who can support you in the right ways? And could there also be investors that you want to avoid for that reason, that they're maybe too hands-on?
The disclaimer: Yolo have not asked me to prepare any sort of statement at all, but they absolutely have been you'd classify them as the dream investor, the old-fashioned concept of a venture capital firm that will come. Yes, they give the capital injection, which is very important, but it's not just that. They really work with you to make 1 and 1 not equal 2, but equal 11. So they bring any sort of resources to bear that's needed. If there's a problem, we sit down and solve them all together, whether it be within the network, whether it be outside the network, whether it be providing strategy and guidance. They're our biggest mouthpiece to customer base, or have been our biggest mouthpiece for a long time to a new customer base, bringing clients. It's really been amazing. The interface between the Yolo team and the One team is very close. And it goes all the way through. It's not just at the shareholder base. There's lots of interaction between at every level. So yeah, as a disclaimer, they did not ask me to say that, but they really have been amazing.
Tim Heath is rolling his thumbs at home listening to this at the moment. But, yeah, fantastic. A final question for you here today, Andrew, is what's the ambition? Let's say, where do you see the business in 3 years' time? What are you working towards?
So I suppose it's expanding on what we've put the foundations in to date. So it's providing a truly sort of global platform for the innovative sector to be able to prosper. So that's seamless international money movement and offering a full suite of financial services made available. So everything from cards to FX to credit facilities to financings, anything that might be needed from a financial service perspective to be able to support their businesses. And that extends all the way into obviously all the crypto capabilities. We're expanding our B2B offerings, also into introducing B2C prospects. We're looking to be able to do this across every region. We'll have every region across the world, so continent and region. Having key pillars present locally with access to domestic payment systems. And the seamless money movement around the world comes from lots of innovative ways we're combining both the crypto sector and the traditional fiat rails to be able to reduce reliance on correspondent banks. So a lot of the pain points you see across the world on payments getting stuck or reversed or slowed or rejected is also to do with the correspondent banking network. So we can reduce our reliance on it and not have to do international money transfers via SWIFT using our own proprietary built network. This becomes extremely powerful. We can set our own risk appetites. Money movement is fast and instantaneous, and also extremely low cost. So this creates this wonderful platform embed that we can both offer new products and services to our customers, but also our customers can leverage to offer new products and services out into the industries that they're servicing as well.
Great, Andrew. It's been a pleasure to see you grow over the last couple of years that I've known you, and I wish you all the best of luck in the future as well. I'm looking forward to see you in person in Valletta in the next month as well.
We'll
Thanks
see
so
you
much
next
for today,
month.
Andrew.
Thank you, Pierre. Cheers. Have a good day.